Okay, so what do usually non-resident Indians think about? Right, the first thing is, okay, is it a right time to invest now? Okay, how much allocation do I put, in which country? Which are the asset classes that I need to concentrate across? And if I'm going to be doing it in India, is equity better or is debt better? How do we rebalance without, missing out on the next best opportunity that's there? Where do we specifically invest? Where do we find that, that position sizing, basically? So these are all things that when you're sitting so far away is what you actually think about. Right? Now, why is it that, you need to think of different strategies when it comes to staying out? Right. One, you get dual tax residency, so naturally you will get some opportunities here and there. Right. You have exposure across different currencies. So if you're running a 401k, naturally you're having dollar exposure as well. Even if you're the UK pension plan, you will have it there. Right. So Singapore also does get some amount of tax benefits here. Right. And their currency has been a little stronger than ours over the last 3 years. So that is a good thing across both. Right. For you here also and for you there also. Right. Then when it comes to valuations, which market for you is the best to go and put money in? Now, given that India is coming to a fair valuation and below fair valuation, at the same time, depreciation also has taken place. So you have a double benefit actually, because you get to acquire, one, you get to put more money. You're getting more for what you're transferring, and second, you will be able to get in more units for what you're actually putting in here, or more shares, right? So double. So when that growth does come in, or when strength and economic growth comes in and bounces back, that benefit comes to you. Okay. Banks optimize for transactions. They don't actually talk to you more about wealth creation. They don't give you strategies in which you should be parking your money in when it comes to taking advantage of undervalued opportunity, right? So if you see majorly compared to Indian debt, your FD there is much better because there they're getting far more than what you'll get here domestically, right? But when you work for with a PMS or a mutual fund, right, somebody who's on the professional side, that's why they will be able to understand, sit one-on-one with you and try and understand what best they should do for you so that you're able to achieve a particular goal, right? So usually there is no hand holding that you get, but here when you do it with a wealth manager, when you do it with a financial planner, you will get a lot of hand holding, right? Particularly from a PMS perspective, because investors here understand PMS to be that of giving you extremely high returns. That's what usually the perception is, but it's not the case. It's a complete different strategy than what you would do on the mutual fund side. So naturally, that one-on-one is required for you to be able to understand when you need to push the pedal, when you need to come back, right? And how far are you from meeting a particular goal? Okay. When it comes to multi-asset approach, that is what Neo is all about, which I will cover now, right? Mandates need to be extremely flexible. So we've kept Neo's mandates completely flexible. This way, you're able to get the best out of putting money in equity, out of putting money in precious metals, out of putting money in, again, global investment ideas as well, and as well as fixed income. Okay, but more or less, these are all optionalities that we sort of build into the portfolio, right? That is why it does require proactive rebalancing, but whereas it's more reactive to your needs when it comes to a bank, and it's more reactive to certain commissions and targets. But here it's not going to be based on that. Here the entire player is going to be you. You are going to be the captain, and we are going to be the coach trying to optimize what's best for you. Okay, that's the entire difference. Now, what you need to do is first try and list out where each of your assets are, know what you own and where. Look at what your current allocation. So we will be able to help you in understanding, where you are currently placed, what is your current asset allocation looking like, and what your actual asset allocation needs to be, not only from a diversification perspective, but more from a legacy perspective as well. Because here and there, both you will have to take that direction in terms of where you're headed, whether you're going to be coming back to India, whether you would be staying there only. Okay, so review that basically these are all legacy is what you need to sort of go out and review. Then when you consider a strategy like Neo, right, work with somebody who understands how cycles work. Right. Understand how is it that they've played each and every single cycle, what their entire strategy is all about, not blindly going to returns itself. Understand whether it will suit your particular needs or not, and whether their expertise will be of good use or no. When you go to a general physician, They will tell you what, the actual issues are. They've seen this template across everybody. But when you go to a specialist, they will tell you, okay, this is the line of treatment that you need to go through, and suggest you that particular direction and path with that doses itself. So that is what you need. Specialization is what you need when it comes to a multi-asset strategy, not a cut, copy, paste sort of model that works only on returns. Okay. We have to work with a completely clear plan. Right? It does not have to be a reaction to what the markets have to offer, but it has to be completely towards a plan. Right? Only then will you be able to take advantage of what the market has to offer to you. Now, if your goal says no, you have retirement coming up, or you need money that is coming up majorly after 2 years or so. So the plan will also will be accordingly only, and then the recommendation that comes from the plan will be based on what your current asset allocation is and what asset allocation we need to build for you, whether it is through a PMS or whether it is through a mutual fund. But the idea itself is clear that every bit of investing has to be with a clear plan. Okay, now coming to India. Now, why is it that India is suddenly becoming that focus point across the world? India has seen a lot of outflow. Money has gone out from India over the last couple of months, and 2025 also was pretty lackluster. That money has gone to other parts of the world, particularly on East Asia or other East Asian countries. You see, Korea has done phenomenally well. So what this has done is that India's premium over emerging markets have started to cool down, and they've come to median and below median. This is slightly dated, but we are right there only. Right? It's just become a little bit cheaper as well from a premium and a discount perspective, right? So discounts are getting a lot more better for you to put money into India. Now, does the story for India still continue to remain? Right? Because here, when you're coming from a slowdown, and geopolitical tensions are not very small, they're pretty high. Inflation does seem to be like it's going to be on the higher side going forward. So, given all of that, does India's growth story still remain strong? The answer still is yes. We still have the favorable demographics. Still, there is a strong macro environment where the Indian economy had that threshold of $80 to $85 a barrel for crude. Today it is 90. Right. So we are structurally getting better. Right. GST reforms also have made it very strong for us in terms of tax collection. At the same time, consumption in India is not seeing that big of a uptick. We are seeing signs of good volume growth coming in now. But overall, right, yeah, consumption is not a very volatile place for India. We've always seen somewhere between 10-11% sort of CAGRs in terms of PAT over decades. This is over 26 years. So this time around, over the last 3 years, we are definitely seeing a slowdown. Now, can that change? Yes, of course. Given how we are placed in terms of our consumption patterns, that does seem to have good potential to change. Again, rising demographics, favorable demographics. You're seeing households come into that middle basket where income growth is expected to be the highest, and spending also is expected to be the highest. So overall, right, we are a full bottom-up, consumption-oriented, infrastructure-oriented, growth-oriented sort of business. Anti-AI is something that you can also say, not much AI-related ideas. So naturally, money is not actually going towards that. There is no story for us to put if it's not anything about AI. If you say anything about AI, is suddenly becoming a very hyped story. So we don't have that story at all right now, right? So naturally, from a bottom-up perspective, yes, which we are starting to look very attractive. From a more story perspective, no, we are definitely not looking very attractive when it comes to a particular story. Okay, but inherent growth definitely is there for grabs. Okay, now when it comes to other stories, right? You look at other parts of the world, you look at UK, you look at US, and wherever most of money is going and flowing into one particular location. Right? Valuations are very expensive on the US part. We've had all-time high numbers coming in over the last 15 days also. You see that their market is becoming extremely bullish when it comes to their AI. But that valuation definitely comes with a good amount of risk. So there is one whole part of the world that is pretty expensive, and then one whole part that is becoming very cheap for us to put money into, particularly in China, particularly in India. So that is something that you should take advantage of. So how our strategy is built is to take advantage only of these uh, mismatches in terms of philosophies. Now, how is it that Indian markets have sort of reacted to every geopolitical crisis? Usually, these crises take about 6 to 7 months to completely play out. Okay. Historical crises also have been the same. This crisis also looks to be very, very similar. Okay. And the good part about all these crises is that with every crisis that has come, we have gotten a lot more better. We have gotten a lot more resilient. Our shock absorbers have been working very well for us. So naturally, that tendency is there that when the bounce back comes, bounce back also will look to be very strong. Probably it might not be this year, but yes, we need to start investing only for 2029 and 2030, given the fact that this year is going to be completely lackluster. There will be a lot of changes that and effects of inflation that we will have to see. Like, but going by history and going by how our macro is sort of developed, we are seeing that India has become a lot more stronger in terms of being very resilient to all these shocks. Okay. Now, how is it that Neo takes advantage of this entire macroeconomic scenario that's there outside? Now, the good thing about Neo is that our landscape is completely open. We have completely flexible mandates to go from 0 to 100 in any particular asset. It's not only direct stocks that we will have the option to invest in, but a basket also is what we will have to as options to go out and invest in. For example, let's take a particular basket. Why don't you guys put it on the chat box to say, okay, is this being covered in the strategy? How are you looking to play this sort of theme or this sort of sector into the strategy? So let me open the floor. Why don't you put it in the chat box and I'll tell you what exactly we are doing in Neo. Okay, I don't see anything coming on the chat box, but what I'm saying is put out the idea, put out the theme that you think is attractive in your mind, and how is it that Neo is taking advantage of given our philosophy? Let's get into that. Power and defense. Okay. Any other sector? Banking. All right. Okay. So when it comes to these themes, right? So when we look to invest in these themes, we have high exposure to conviction themes that contribute to GDP. Okay. We look to back only market leaders that are operating in favorable industry structures while being very conservative in terms of valuation. Now, defense valuations are pretty high, so that goes out of the picture. Okay, but power and the banking definitely are extremely attractive. And that happens to be two of these baskets that were investing in very aggressively, right? So there is financial services in as a theme, financialization of Indian households as a theme that we are investing in itself, and it's one of our largest weights. And power also is starting to become a very strong basket because of so I'll take power and commodities both together because of inflation, right? So we do have both these both these themes that are coming within the equity asset bucket, right? This philosophy allows us to laterally shift between asset classes across market cycles when something becomes overvalued and the other thing becomes undervalued. So there is a lateral shift between equity and debt, or debt to precious metals, or equity to precious metals, whatever the opportunity be, right? But this level of opportunity, for example, when we look at putting money, we look at it from this angle. Okay, so we look at it. So now we have a thematic idea. We bucket it down between top down and bottom up. Then we try and understand this. Does this top down approach require an active strategy or a more basket oriented approach? Now, for example, on banking, what we did was we took something on the overall bucket side. Okay, we looked at public sector banks as an index, right? So this was a more top-down approach that we understood that no, this is a scenario where banks are looking extremely cheap, NPA levels are coming down, and government has only recapitalized all these banks from 2018 up until 2020, so 2021. So we didn't have too much of a problem when it came during COVID as well. So we understood that structurally banks are changing very strongly. So we took that top-down approach. Then we took, okay, from a valuation perspective, do we need to pick one or do we need to pick the entire basket? And basket was what we found is particularly cheap. Then we decided that, okay, this requires for us to take a sectoral theme. Right? So we took that entire basket as an idea. Whereas if you're looking only at bottom up, then naturally an active strategy is required. So complementary strategies between active and passive is what we will look to do when it comes to investing in Neo. Right. So this does take some amount of time. It does take somewhere between 6 to 7 months for us to deploy that capital in a particular high conviction idea. Sometimes it can take long. So we are only staggering our investments in and we are only staggering our investments out. Right. This is how we will look to play. And this is how we will look to invest across asset classes, which is not just equity, across asset classes, given this particular mindset, right? So we don't have a cap on any particular asset class. It is a mix of top down and bottom up, and it is concentrated across themes with a market leadership bias. So we will want to invest particularly in market leaders, right? Be it from a bucket perspective or be it from a direct stock perspective, right? What we've understood is we want to build versatile portfolios that prosper in all markets. Right? Usually there is a different winner and there is a different loser across market cycles, and we want to capture that entire cycle, right? So it will take us time to build, but naturally, the way we position ourselves, we should get that reward for the risk that we are taking, because we are very conscious in terms of the valuations that we pay. Naturally, our risk on that side is captured nicely, which means we are not taking too much risk. So naturally, that reward also should start playing out in the future. So if you are investing in, if you're looking to do something on the new side, have that idea that this is going to be a 5 to 7 year sort of product. This is not going to be a 3 to 5. Understand, this is going to be a 5 to 7 year sort of product. Our entire idea itself is to capture themes. Current theme that we are doing right now is more on the financialization side plus market leadership, which is leading to an all-weather strategy. Right. Consumption also is a bucket, and now we are also looking to do majorly on power and commodities, right? So that is something that we build. So we'll always have new ideas to go out and start putting capital in, right? So your average expectation, what should your expectation be for a strategy like Neo? That is average inflation plus 5 to 7%, right? So we are operating somewhere between moderate to conservative in terms of risk appetite. So if you're falling within and you think that you are, we'll obviously help you take the risk profile test. But from a personality perspective, if you feel that you fall in the middle, then this product definitely is going to suit you. Our entire objective is that to create wealth, preserve, and then sustain that level of wealth creation. Right? Because we're able to seamlessly move across overvalued to undervalued. Okay. There's a question on power theme is not investing in M2W and Neo PMS are completely different. Please don't try to mix both buckets. Okay. And different risk profiles as well. So don't try to mix two buckets. Okay. Now, how does Neo how does Neo see drawdowns, right? If you see what happened in March, right? We had a very, very turbulent time in the market. Now, Nifty saw a drawdown of around 15%. Neo saw a drawdown of about 13%. So we are falling lesser than the market, right? But at the same time, our recoveries also have been very, very sharp, right? So falling less, which means a good amount of volatility is captured and a good amount of stability is there. At the same time, when those recoveries start to take place, we've seen that the recovery also is much better than that of your broader indexes, right? Of course, if we compare to our own index, which is going to be the multi-asset index, we are much more better because we are taking a little bit more risk itself than the index. But going by broader markets itself, we have shown good amount of resilience when it comes to managing volatility. Okay. And what about returns? So returns also since inception, our inception is in 2022, and that also has been very strong. But what I wanted to peg to is that going forward, it should be average inflation plus 5 to 7% on a CAGR basis. Right. So we have seen good amount of performance coming in. Right now, the way we have positioned the portfolio is to have more on equity. So our equity allocation started to go up in the month of March. Our debt still is there, but that has been coming down now, and precious metals also has been coming down. So we are now you're seeing that flexible mandates in terms of 0 to 100, no cap on a particular asset class playing out very, very well, where we are able to go extremely overweight on a particular undervalued asset category. Okay. Minimum investment is going to be 50 lakhs INR, and there's a fixed fee of 1.5% per annum on your daily average portfolio value, which is charged on a quarterly basis. Right? Again, no cap on a particular category. Here, Shyam sir is the CIO and the fund manager. We have other strategies as well across flexi, large, small, where we have a very, very strong roster. So Rohit and Rajat are part of the small cap PMS. Niranjan and Samyukta both are part of the Sphere and Neo. So they are co-fund managers, right? Along with Shyam sir. And then you have Sanjay, who's part of large cap, and Gaurav and Sindhu, who are part of the Solitaire team. Then you have the entire research team, and then you have the entire strategy team as well down. And my name's also there. So that's about it that I have from a Neos perspective and from India market perspective. So, all right, done. Thank you so much for your time. Have a great weekend ahead. Thank you, guys. Thanks.